Most retirees do not think about required minimum distributions until the year they turn 73. Then, the IRS sends them a surprise. You must withdraw a specific amount from your retirement accounts every year, whether you need the money or not. And if you miss it, the penalty used to be 50% of the amount you should have taken. It is now 25%. Still, one of the harshest penalties in the entire tax code. Today, I am covering the complete guide to required minimum distributions, what they are, exactly how they are calculated, which accounts are affected, what happens if you miss one, and 5 strategies to manage RMDs without paying more taxes than necessary. This video is relevant for 3 groups. Group 1, people between 65 and 72 who have time to prepare before RMDs begin. Group 2, people approaching 73 who need to understand what is coming. Group 3, people already taking RMDs who want to know if they are managing them optimally. One important context. Secure 2.0 raised the RMD starting age from 72 to 73 for people born in 1951 or later, and it will raise the age again to 75 for people born in 1960 or later, starting in 2033. So your RMD start age depends on your birth year. We will cover exactly how to find your personal start date. What exactly is a required minimum distribution? It is the minimum amount the IRS requires you to withdraw from certain retirement accounts each year, starting at a specific age. The IRS has been patient while your money grew tax-deferred. At age 73, the patience ends. They want to start collecting income taxes on your savings. Which accounts are subject to RMDs? Traditional IRAs, traditional 401k accounts, including old employer 401ks, 403b accounts, 457b governmental plans, SEP IRAs, simple IRAs, inherited IRAs for most non-spouse beneficiaries. These are all subject to RMDs. Roth IRAs are not subject to RMDs during the original owner's lifetime. Roth 401k accounts, as of 2024, are also no longer subject to RMDs. How to find your personal RMD start date. If you were born in 1950 or earlier, your RMD started at 70.5 or 72, depending on when you reached those ages. If you were born between 1951 and 1959, your RMD starts at age 73. If you were born in 1960 or later, your RMD starts at age 75, beginning in 2033. When in doubt, confirm with your IRA custodian. The first RMD deadline. Your first RMD is due by December 31st of the year you turn 73. However, for your first RMD only, you have the option to delay until April 1st of the following year. Important warning. If you delay your first RMD to April 1st, you must take 3 RMDs in that same year, the delayed first one and the regular second one. This can spike your taxable income significantly. How is your RMD calculated? The formula is simple. Take your total IRA and traditional 401k balance as of December 31st of the prior year. Divide that balance by your life expectancy factor from the IRS Uniform Lifetime Table. The result is your minimum withdrawal for the current year. The IRS Uniform Lifetime Table, life expectancy factors for key ages. At age 73, the factor is 26.5. At age 75, the factor is 24.6. At age 80, the factor is 20.2. At age 85, the factor is 16.0. At age 90, the factor is 12.2. The factors decrease each year, which means your RMD percentage increases as you age. Real calculation example. George has a traditional IRA balance of $620,000 on December 31st of last year. He is now 73. His IRS factor is 26.5. His RMD calculation? $620,000 divided by 26.5 equals $23,396. George must withdraw at least $23,396 from his IRA this year. He can take more, but not less. If you have multiple IRAs, you calculate an RMD for each account separately, but you do not have to take the RMD from each account individually. You can aggregate the total RMD amount from all your IRAs and take it entirely from one account. This is called IRA aggregation, and it simplifies management significantly. 401k accounts cannot be aggregated with IRAs. If you have both a traditional 401k and a traditional IRA, you must take the 401k RMD from the 401k account and the IRA RMD from an IRA account. You cannot combine them. This is a common mistake that creates compliance problems. Still working exception. If you are still working at age 73 and have a 401k with your current employer, you may be able to defer RMDs from that specific current employer plan until you retire. This exception applies to the current employer plan only, not old 401ks or IRAs. Check your specific plan document. What happens if you miss an RMD or take less than required? Before Secure 2.0, the penalty was 50% of the shortfall, one of the most severe penalties in the tax code. Secure 2.0 reduced it to 25%. And if you correct the mistake in a timely manner, within 2 years, the penalty drops further to 10%. The IRS also has a process to request a waiver of the penalty for reasonable cause. If you missed your RMD due to illness, confusion about the rules, an advisor error, or other reasonable circumstances, file Form 5329 with your tax return and request a waiver. The IRS has historically been receptive to first-time waiver requests for people who take corrective action. If you discover you missed an RMD, take the missed amount immediately. File Form 5329 with your tax return to request the waiver or pay the penalty. Report the late distribution as income in the year you took it. Do not try to ignore a missed RMD. The IRS will eventually identify the shortfall when your custodian files Form 5498. Now, the 5 strategies to manage your RMDs without paying more taxes than necessary. These strategies are especially powerful in the years before RMDs begin, but several of them remain effective even after distributions have started. Strategy 1. Roth conversions before age 73. Every dollar you convert from a traditional IRA to a Roth IRA before RMDs begin permanently reduces your future RMD base. A $50,000 Roth conversion at age 67 does not just move $50,000 out of RMD reach, it removes all of that money's future growth from RMD calculations as well. The optimal Roth conversion window for RMD reduction? The years between retirement and age 73. If you retire at 63 and have 10 years before RMDs begin, systematic annual conversions can dramatically reduce your RMD base. Converting $30,000 per year for 10 years removes $300,000 from your future RMD calculations, plus all growth on that amount. Strategy 2. Qualified charitable distributions. If you are 70 and a half or older and give to charity, QCDs are one of the most powerful RMD management tools available. A QCD allows you to direct up to $105,000 per year directly from your IRA to a qualified charity. This satisfies your RMD requirement without the distribution appearing in your taxable income. The cascade effect of a QCD. When you satisfy your RMD through a QCD, you remove that amount from your AGI. Lower AGI means less of your Social Security becomes taxable. Lower AGI means potentially lower IRMA Medicare premiums. One QCD creates 3 simultaneous tax benefits. For someone with a $25,000 RMD who gives to charity anyway, doing it as a QCD versus taking the RMD and writing a check saves approximately $5,500 in combined federal taxes. Strategy 3. Reinvest your RMD if you do not need it for spending. Many retirees take their RMD and let it sit in cash, or worse, spend it unnecessarily. If you do not need your RMD for living expenses, immediately transfer the after-tax amount to a taxable brokerage account and invest it in the same index funds your IRA holds. The money continues growing, just in a different wrapper. Reinvesting your RMD also builds a pool of taxable assets with a step-up in cost basis at death. When you inherit a taxable brokerage account, you receive a step-up in basis to the fair market value at the date of death. This can eliminate capital gains taxes for your heirs on years of accumulated growth. A thoughtful strategy for legacy planning. Strategy 4. Aggregate and time your RMD strategically. You do not have to take your RMD on January 1st. You have until December 31st. This flexibility lets you manage your taxable income more precisely throughout the year. Why timing matters. If you take your RMD in January, it affects your full-year income planning immediately. If you wait until October or November, you have a clearer picture of your total income for the year and can decide whether to take exactly the minimum or take more to fill your tax bracket efficiently. Most tax-aware retirees take their RMD in the fourth quarter. The bracket filling strategy. Once you know your projected total income for the year in October, you may find you have room in your current tax bracket to take more than the minimum RMD without crossing into a higher bracket. Taking extra in low-income years reduces future RMD pressure when income might be higher. This is especially valuable in the early years of RMDs. Strategy 5. Consolidate your retirement accounts before RMDs begin. If you have multiple IRAs at different institutions, consolidating them into one or two accounts simplifies the RMD calculation process significantly and reduces the administrative burden every December. Benefits of consolidation beyond simplicity. Fewer accounts means fewer chances to miss an RMD deadline. Fewer accounts means fewer custodian relationships to maintain. Fewer accounts means beneficiary designations are easier to keep current. And consolidation often reduces total account fees if you move to a low-cost provider like Fidelity, Vanguard, or Schwab. Case study: Margaret, 74, took her first RMD last year and is struggling with the tax impact. Her traditional IRA balance is $840,000. Her RMD this year, at age 74, with a factor of 25.5, is $32,941. Combined with her Social Security of $28,800 and a small pension of $12,000, her total income is $73,741. She is in the 22% bracket, and 85% of her Social Security is taxable. Margaret applies 3 of the 5 strategies simultaneously. Strategy 1. She begins converting $15,000 per year from her IRA to Roth, staying within her 22% bracket ceiling. Strategy 2. She directs $12,000 of her RMD as a QCD to her church, reducing her AGI by$12,000. Strategy 3. She takes the remaining $20,941 RMD in October after her income picture is clear. Margaret results. The QCD reduces her AGI by $12,000. This keeps more of her Social Security in the lower taxation tier. Her estimated federal tax savings from the QCD alone, approximately $2,640 per year. The Roth conversions will reduce her RMD base by approximately $195,000 over the next 13 years before age 87, meaningfully reducing future forced withdrawals. Special topic: Inherited IRA RMD rules. If you inherited an IRA from someone other than a spouse, the rules change dramatically under Secure Act and Secure 2.0. For most non-spouse beneficiaries who inherited after December 31, 2019, you must empty the account within 10 years. The 10-year rule requires the account to be completely empty by December 31st of the 10th year following the year of death. You can take any amount in any year during those 10 years. There is no required annual minimum for many beneficiaries. But you cannot let the account sit untouched and take everything in year 10 without tax planning. Spouse beneficiaries have different options. A surviving spouse can roll the inherited IRA into their own IRA, treating it as their own account with their own RMD schedule. Or they can remain as a beneficiary, which allows access before age 59 and a half without penalty, useful if the spouse is younger. Consult a CPA or financial advisor about which option is optimal. Your RMD action checklist. 5 actions based on where you are in your retirement timeline. If you are between 65 and 72, your most valuable action is to calculate your projected RMD at 73 using your current IRA balance. Go to your IRA custodian website, find your current balance, and divide by 26.5. That is a rough estimate of your first RMD. Then ask, can Roth conversions reduce this amount before the clock starts? If you are approaching 73 or just turned 73, confirm your exact RMD deadline with your IRA custodian. Set a December calendar reminder for December 15th, 2 weeks before the year-end deadline, to confirm your RMD has been taken. Automate the distribution if possible. If you are already taking RMDs, evaluate whether any of the 5 strategies apply to your situation. Do you give to charity? Convert QCDs. Do you have a low-income year? Do extra Roth conversions. Do you have room in your bracket? Fill it strategically. Do you not need the money? Reinvest it immediately. Everyone with an IRA, consolidate your accounts. If you have IRAs at more than 2 institutions, pick your lowest cost provider, Fidelity, Vanguard, or Schwab, and initiate a direct trustee-to-trustee transfer of the other accounts. This one-time administrative task will simplify your RMD management for the rest of your retirement. Inherited IRA holders. If you inherited an IRA after 2019 from a non-spouse, confirm your 10-year clock. What year did the original owner die? Add 10 years. That is your hard emptying deadline. Make a tax-efficient distribution plan that spreads the income over the 10 years to avoid a massive taxable year at year 10. If this video gave you clarity on RMDs, please share it with one person you know who is approaching 73 or has recently started taking distributions. Most people navigate this without guidance and pay significantly more than necessary. You now have the framework. Share it. Drop a comment. What is your biggest question about RMDs? Calculation, timing, strategies, or inherited IRA rules? Your question likely reflects what many others are wondering too. Subscribe to Calm Money Retirement. Every Tuesday and Friday, one retirement topic explained slowly, clearly, and without pressure. This Friday, 10 things nobody tells you about the first year of retirement. The emotional, practical, and financial surprises most new retirees face. Disclaimer: this video is for educational purposes only and does not constitute personalized financial or tax advice. RMD rules, penalties, life expectancy factors, and inherited IRA rules change over time and vary by account type and individual situation. Please consult a licensed CPA or fee-only financial advisor before making RMD decisions. Calm Money Retirement is not a registered investment advisor.